Mr. Sitapati, the MD and CEO at Godrej Consumer Products, joins us on the show. Hi, thank you so much for making time and speaking with us. I just wanted to begin by asking you that this is the second consecutive quarter of double-digit volume growth. Is it safe to say that the worst is behind and this double-digit growth is likely to be sustainable for FY24, both in terms of volumes as well as revenue?
I don't think double-digit volume growth is the trajectory that we will be on for the next couple of quarters. I think it is fair to say that our trajectory will be higher than the trajectory it has been in the past. But both this and last quarter were good quarters, aided a little bit by weather that was conducive to household insecticide sales. So I think things are looking good on a longer-term basis. But these two quarters have been optically better than what we anticipate quarters in the next few quarters to be.
The rural accounts for 30% of your total sales. What is the growth in rural versus urban, and if you could quantify that for us?
Rural business continues to do a little weaker than it was doing pre-COVID. It is now growing around roughly at the level of urban. Prior to COVID, rural was growing significantly faster than urban. So rural is not quite the kind of tailwind that it was in the past. And really, it's more equitably spread between urban and rural, the volume growths.
The home insecticide segment as well has witnessed double-digit growth. How much of that is due to the beneficial weather conditions? And do you think that this growth within the segment is sustainable?
I mean, some of it is because of beneficial weather conditions. Some of it is because of innovations and advertising. This is a category that fluctuates based on seasons. And just as we have some quarters in which we have poor household insecticide results due to weather, this one has been the opposite.
Sudhir, I also wanted to talk about the EBITDA margins. It was a very strong show this time, at least when it comes to the India business. But the question is, will you have to part with some of these EBITDA margins that we are seeing, and it will go away on account of higher spends in marketing, etc.? What's your take?
Oh, I mean, I don't think I think the EBITDA margins have recovered to our historic EBITDA margins, albeit with a very different shape of P&L. Lower gross margins, higher advertising, lower costs. I don't anticipate EBITDA margins unless there is some hyperinflation cost, in which case we have some principles of not passing it on to consumers. But that is not what we anticipate going forward. So we anticipate EBITDA margins to kind of roughly be where they are, or maybe slightly improve.
Growth in Africa has been for 2 quarters due to devaluation of currency. Have things normalized? Could we see continued weakness there?
No, I mean, I don't think I think the Africa performance has been good in the past quarter. The way to measure the Africa performance is, cash flows and volumes, both of which have been quite good. In the subsequent quarters, there's been a very sharp devaluation of the Naira. Some of the devaluation has been optical, where the parallel market rate and the real rate have now kind of converged. So there will be some optical changes in the P&L, but this should not affect either underlying volumes or cash flows.
Now, Indonesia as a region is returning to growth. So what is the difference between the primary and secondary sales now, and our margins looking sustainable?
The Indonesia business has had a good recovery, despite the fact that even in this quarter, we have continued to downstock in modern trade. Despite that, we've had a good quarter. So our secondaries are ahead of our primaries. This augurs well for us in the next few quarters as well. I think the good thing about Indonesia is the Indonesian macros are looking good. Our own processes and business is looking good. And our market shares are looking good in Indonesia. So our prognosis on Indonesia is reasonably bullish going forward.
Okay, so bullish on Indonesia, that's the word coming in. But Sudhir, the capex that you outlined in terms of your commentary after the earnings, how are you going to fund this? And secondly, which product lines will you be prioritizing in the order of the capex that you're going to undertake?
I think the purpose of our capex is threefold. First is we anticipate volume growths to be pretty high in the next few years, as they've been in the last few quarters. And we need capex to fund volume growth. Secondly, we need to get our manufacturing footprint to be more efficient in terms of logistics. And thirdly, we need to increase our automation so that we can reduce our conversion costs. So these are the three drivers of our capex plan. Our capex proposal is about 900 crores over 3 years, which is doubling of our existing capex rate over the last few years. We can pretty easily fund this from our operating cash flows.
Okay, Mr. Sitapati, on that note, we'll let you go. Appreciate you joining us on the show. Let's take stock of